it was just over. It was crazy. You learn these certain things as you go through in your career, certain tenets of how you want to build your company and how you want to operate. And you just see how these guys have just, not even nerves of steel, but are just so disciplined and convicted in that if it's not the right thing for them, losing your hard money is much better than moving forward on a transaction. When you are buying and you kind of are on the front end, you need to have a long-term perspective. It's another kind of opportunity where the market's going to reset. You need to stay disciplined. You need to be present. You need to be available. You need to be transparent. You can't let anybody down that's made a commitment to you. And then at the same time, you need to really be ready for what's ahead.
Welcome back to another episode of the Fundication Show. My name is Kalani Michelle, and I am here with my co-host, Mr. Christian Sadler.
Hey, everybody.
And we are filming at our studio in Salt Lake City, Utah. We are pleased to have Mr. David Zeff here. He is the president of Sterling Partners, and we are going to invite David to tell a little bit more about himself. Before we do, David is one of our approved sponsors, and we have an approved sponsor program. And what that is we will currently allow 50 sponsors to join our approved sponsor group. And with that, they get exclusive benefits to some of our services, such as top-off services, pref equity. If they have certain raises that they're doing that are 506c offerings, we'll allow them to come onto our show and talk about those offerings. And we have many other benefits for our approved sponsors. If you are interested in becoming one of our approved sponsors, go to PREIshare.com/become-un-approved-sponsor, or just visit the link on the screen. Before we dive in any further though, we have something special for David, and I'm going to hand this over to Christian so he can explain kind of what we're doing here and what we have for David before we get started.
Well, what I'm actually going to do is I'm going to ask our president and CEO, Mike, to step up here as well. And if we could all just come up to the front, I want to give David a plaque, just recognizing your approved status with PREIshare. We look forward to doing a lot of business with you as things move forward.
Wow, that's great.
Absolutely.
Mike? Well, thank you. It's when I connected with Mike, I thought what you guys were doing really resonated with me personally, but also with our platform and with our investor base. And so it's been a pleasure to get to know all of you, and I'm happy to be here. So thanks for having me.
Well, we're grateful to have you as an approved sponsor. And for the audience, I want to make sure that they understand a little bit more of what this actually means and what our services are. And I think you are pretty familiar with what we're doing. And I believe that the market, really, it's the time and the need for this, which is we're providing liquidity in the market. And so first and foremost, what PREIshare wants to do is create liquidity for the passive investors, which makes it easier for you on your raises if you can offer that liquidity to those passive investors. And so we're creating a listing hub where there will be an open marketplace for those transactions of fractional shares. But also with the PREIshare fund, we will be buying those fractional shares. And so we want to be able to give that immediate liquidity. On top of that, because you're an approved sponsor with us, you're going to have access to our top-off services, and you'll have access to our pref equity. So if you're ever in the time where you need those extra funds to finalize your deal and get to that next capital event, we want to be there for you.
Well, that's great. There's no question you guys are filling a need in the market on all different levels. So it'll be nice to be able to offer the liquidity to our investor base. And on the sponsor side, when we're getting close to the closing, and if there is a gap that's needed, that the assurance that it's there and it's available. So we're excited to work together.
Well, we're so excited to have you here, David. And can you tell our audience a little bit more about your background in real estate and what you're doing now?
Yeah, you bet. Well, I started in the business in 1992 in downtown San Francisco. So hard to believe it was kind of pre-internet, but it was really an amazing collegial environment. You had to be, in order to get information, generally a lease comp or a sale comp, you had to know somebody that was part of the transaction. So generally Thursdays and Fridays for happy hour, all the real estate brokers, everybody would meet up at one of the local pubs and bars, and people would just be social and exchange information. And it was a really interesting time. And I started with a company that was fully integrated. we started buying Class B office buildings in downtown San Francisco, where we would never pay, our mantra was we would never pay more than $100 per square foot for an office building. So I think today those are probably rental rates. But nonetheless, that was really where I received kind of my first taste of real estate and the wealth creation and the value creation opportunities that you could have as a sponsor. And the company was, the downtown San Francisco and the real estate market was in a little bit of a shift at the time, where some of the companies were starting to come out with their own sponsor, their real estate funds. And one of the biggest companies in San Francisco was the Shorenstein Company. And they were in a transition from Walter to his son, Doug. And there were some of the older people that had grown the company with Walter Shorenstein were leaving the firm, and they came to work for the company that I was at. And that was really where I learned from kind of the old guys in the business that were dyed-in-the-wool real estate, how real estate worked. And I'm in the conference room with my HP12C trying to punch out an IRR, and these guys, they're rattling off the numbers off the top of their head. I mean, they do the math, they know all the metrics, and it was really an incredible environment. And as things started to progress, we got to 1999 with the internet and the dot-com bubble and everything that was happening. We had a lot of horsepower behind us. We had a lot of institutional capital behind us. And then literally the music stopped. And people that have been in the business in the last, say, 10 years are getting a little bit of a taste of that. But literally in the dot-com era, people would go home on a Friday, and that was it. They would never go back to the office. We would walk into some of these beautiful office spaces, and there still would be the coffee cup on the table, the pen on the desk, the sticky notes on the computers. Like, it was just over. It was crazy. It was just really a sight to be seen. So that was where I kind of worked through my first downturn. Our institutional partner pulled all of our management contracts, and you could start to see how the cracks start to really just come into certain companies if they're not capitalized correctly, or partners start to do different things. And as much as they liked the owner of the company, their hand is kind of forced by other outside influences. So from there, I went to go work for another Bay Area real estate company that was all internally capitalized, which was another incredible environment. Some of the smartest guys and disciplined guys that I had worked with, and we'd be negotiating loan documents, and literally on the day of closing, if they were still prepared to walk away, if they couldn't get things that were the way they wanted them, or if they were trying to work something out with the seller. And my point is, you learn these certain things as you go through in your career, just kind of certain tenets of how you want to build your company and how you want to operate. And you just see how these guys have just not even nerves of steel, but are just so disciplined and convicted in that if it's not the right thing for them, losing your hard money is much better than moving forward on a transaction. And so to kind of sit there riding shotgun or be in the conference room or on these conference calls in this environment is really where I realized that it's an incredible business. And that's when I decided I wanted to launch and become a sponsor and start my own company. So I started my own company. I started my first company in 2005, the predecessor to Sterling Real Estate Partners, a company called Pacific Real Estate Partners. And we were a sponsor of commercial properties in Northern California, kind of San Jose to Sacramento. And my first JV equity partner was GE Real Estate, when GE was really a company, frankly. But at the time, they were one of the biggest companies in the world. They had a real estate arm. They were doing joint venture equity. And a good friend of mine at the time was working there. And I decided if I could get through that meat grinder, that having GE as an equity partner would be the best calling card that I could have. And it turned out to be true. So we bought a small little office building in Northern California, and it all worked out. And that's kind of where I really kind of launched things and started the business with having both institutional capital partners, so I could operate and execute on the institutional scale. And then we had to fill in some of the equity, or for smaller transactions, we started to build out our high net worth investor base. And I always felt that was important, to be able to offer high net worth investors with institutional execution and reporting and the mindset. So from there, we bought some office buildings in Northern California with, like I said, with other institutional partners. And that led us to kind of 2008 and 2009 when that was the first real liquidity crunch that we all experienced. And all of my partners wanted me to be office guy in Northern California. Dave, we love you. You're our office guy. No problem. And I quickly realized I'm just going to die on the vine. Like when the best floor of the B of A building in downtown San Francisco can't be leased, there's just no demand. And so that was when I made the switch to residential. And so I just started buying and flipping houses, as I call it, to make wages. So had to get down and dirty into the survival skills. And that was where I realized in residential, it's obviously one of the need-based kind of market segments of real estate. And so through that, we started buying smaller apartment communities. And I realized the agencies, Fannie and Freddie, were still providing financing. And so there's pretty much constant liquidity on the debt side. And on the exit side, you have the 1031 market. There's just more liquidity generally in that space. And so that was when I realized for my money and for my future, I was making the transition to residential. And so we bought some notes, we did some REO stuff, we did some seller carryback with some of the big banks. Washington Mutual was one of the real prevalent market or lenders at the time, and Chase bought them. So we were kind of trying to mine those opportunities that were available. And that was where we really I launched the multifamily platform from there. And so we went from California to Nevada, Arizona, and Texas. We realized that owning real estate in California, the tenant laws are just so friendly that operating in the Class C space, it's tough to get your real estate back. And that's really one. If a tenant's not going to pay you, you just want to get your real estate back. And it was costly, it was time consuming. So we quickly moved to states where we could get our property back, generally in the same month that they wouldn't pay. And so that led us to Arizona, Nevada, Texas. And kind of fast forward, we ended up working on getting a $30 million equity commitment from a closed-end private real estate fund for the platform. And that was the point in time where I realized I needed to be in one of the markets where we were doing business. And so we were predominantly in Arizona and Texas. We were kind of getting out of Nevada. And so in 2005, that was when I relocated with my wife and our two girls to Phoenix. And that's where we've just grown the platform, and that's where the company's located now. So.
Yeah, that's great. It's a lot to unpack, but some of the things that stuck out to me is you've now been through two real major downturns, and they were different but similar, it sounds like. What are some of the biggest learning lessons that you took from those?
You need to stay disciplined. You need to be present. You need to be available. You need to be transparent. And you can't let anybody down that's made a commitment to you on your existing stuff. And then at the same time, you need to really be ready for what's ahead, because it's another kind of another opportunity where the market's going to reset, and that's where you want to be. So it's also, what it also taught me is when you are buying and you kind of are on the front end, you need to have a long-term perspective. Everything can't be so short term, because the market can change like that. You're not going to know what it is, and it's going to happen. There's going to be something. Nobody thought that that Silicon Valley Bank we were going to have a banking crisis because interest rates were rising, and so you have to be prepared for that. So you have to be disciplined in your approach and in your valuation and in your business plan, because that's going to be the ultimate survival, is that preparation as the markets start to change.
Yeah, and I'm guessing on the commercial side, it was probably a lot longer term looking, and then you switched over to more residential where you were probably looking at a lot shorter cycle. And now you're saying you probably transitioned that to a longer. Is that what I'm understanding?
Well, the commercial market is just, it's such a capital intensive business, office buildings, and the demand drivers are so different. And so you really need the staying power the institutional staying power behind you to ride out the cycle. So on the multifamily side, our platform is built both for short-term value-add investments, but longer term holds. Is that what you're asking?
Yeah.
So, in real estate back then too, it was a get wealthy over time business plan and investment class. It was started off as an alternative asset class, and slowly it's become more transparent. There's more people have a better understanding about it. It's more of a common asset class. But what we've seen lately over the last several years, or before leading up to 2021, was it turned into a very short kind of traded asset class, and that was a benefit of the moment in time when interest rates were plunging and the economy was taking off and there was a lot of growth, and you could buy an apartment complex, rent 10 units and get a big rent premium and sell the rest of your rent roll on that premise. And so, right, like I said, it all worked out if the timing worked out, but long term, it's not a sustainable business plan. So you look at the guys that bought real estate, put a 10-year fixed rate. Imagine if you had a 10-year fixed rate loan, interest only at plus or minus 3%. You don't have any issues. So, those are, and not to say that we didn't participate in kind of the short-term hold cycle, but we weren't super deep on it. And right, you don't want to be sitting on a lot of loan maturities coming up over the next 18 months. So
David, we're filming this spring 2023. We've interviewed different sponsors on the show. We've had multiple conversations with various sponsors. What has been your strategy over the last 2 years, where we've had some sponsors that they really have not bought any assets? They're just sitting on cash waiting for an opportunity that may come available, in the next year or two. What has been your strategy, during COVID and kind of post-COVID, in terms of purchasing assets?
So post-COVID, it was interesting. As the markets really just started to take off, cap rates just plunged, and it was overnight. It just felt like literally a matter of months or 6 months. Apartments in Phoenix went from 100,000 a unit to 200,000 a unit to $300,000 a unit. Soon, Class B assets were trading above replacement cost. It just cap rates below 4%. And that was, going back to my days in San Francisco, that was one of the red lines. You don't buy above replacement cost. You just don't. And so we never participated in that. And so we took advantage, or we started receiving incredible offers on our assets. We just felt that they were overvalued. And so we sold down a lot of our portfolio during that time period. During COVID, we were looking for where we could find distress and good buying opportunities. And we bought a couple of hotel assets. So one of them was in bankruptcy. Another one was a large 10-acre kind of low density property in Tucson that we'll end up talking about. We just felt like we could move in other areas of the market where we had more perceived value than just cap rates are going to go down, interest rates are going to stay low forever, and the next guy is going to pay me more than what I bought my asset for. So we're spending a lot of our time now, where our portfolio is very thin, thankfully, and we're spending our time primarily on an adaptive reuse project, and then we bought a fully entitled 10-acre land site in an opportunity zone in West Phoenix. And again, that felt at the time there was better value to build. If you could build for less than what an 80s asset is selling for across the street, then that obviously justified that investment. So what we decided at the time is that we would build out different platforms within the company. Our bread and butter would always be the existing value add. We got into the adaptive reuse space and into the new construction space. So depending where the markets were at any given time, then we could navigate in any of those areas and making sure we're providing the best value for ourselves and for our investors.
Is there a big difference in the team that you need to have in place in those 3 different assets?
Definitely. Yes. The value add space, operations are just key. And my operating partner, Leanne Schofield, we've been together for 8 years. And she came up through the operations side through Greystar. And so that's a skill set that you have to experience in order to really learn it. And so that is by far, that's her bread and butter. That's a real true strength. The adaptive reuse is different. It's an entitlement game. It's really probably that parallels new construction more than the value add to a certain degree because of the entitlements and all the planning and everything that needs to go into that. So in that business plan, you rely heavily a lot on professionals, but there is some correlation on the existing assets. So we know what we want our units to look like, and we have a good understanding of what's going to lease in the kind of infrastructure and the real estate that we want to design. And then new construction, yeah, it's a whole different animal.
Yeah.
All the way through. So.
And I mean, luckily you were buying fully entitled, so you kind of knew what you were going into. Is that the same with the adaptive reuse? Did you have some of those entitlements in place as far as switching the zoning, or did you go into it just kind of knowing that you would be able to get that done?
No. So luckily during COVID, we probably had more negotiating power at the time than you would today. And so we were able to negotiate zoning contingencies and entitlement contingencies. So we also felt that we were mitigating our risk a little bit if with kind of like a quasi option on these sites as we were taking it through the entitlement process. But once you get into the city, they generally want the adaptive reuse. They want to see these properties put to a higher and better use, especially if you can offer just lower cost housing at a lower whole dollar price point.
Makes sense.
Yeah.
So what do you think, David, the market will look like in the next couple of years? We're already seeing changes from 2 years ago. With your experience, I mean, you've gone through 2 market cycles already. What do you think is going to happen?
There's definitely the haves and the have-nots, right? If you had long-term debt on your assets, you're in good shape. If you didn't, you're going to be capital constrained. You're going to have a lot of issues. Certainly the banking environment is a bit of a wild card, but predominantly majority of the financings were done through Fannie Mae and Freddie Mac. So depending on what kind of loan maturity you had on those and what have you, you may or may not, there may or not be issues there. So I think there'll be select opportunities on the distress side. I don't think it'll be as widespread as it was back in 2010. And I think going forward, the market fundamentals are still really strong. And that's why a lot of people are able to continue to operate their assets and service their debt. And there'll be some areas in the Class A market that's oversupplied. And in our portfolio, we've always seen that the Class C and the lower end market has always done the best in good markets and bad markets because there's more people that can pay a lower rent. And so the Class A market is where people have the renters by choice. They'll have flexibility to pay $2,500 or pay $1,800 for a unit. And so and those projects that are under construction all have to finish and come online. So there'll be some softness at the top end of the market. And a lot of that too is geographic specific. The West Valley of the Phoenix MSA has a lot of new construction, and there's some other areas that don't. So you'll have different pockets in different areas. But I think that's kind of where the opportunity lies. So for us as a smaller firm, we'll pick through it. We'll rely on our experience and our market knowledge and a lot of our relationships to try to find those opportunities. And I also think on our development site, there won't be a lot of new housing starts. And so for us on our site, as we're kind of going through some redesign and what have you, our plan still is to try to get under construction late this year, early next year. So I believe that if you can, that will serve us well because that 2-year construction cycle would put us at a delivery point in time where a lot of the existing inventory is worked through and there won't be a lot of new completions at that time.
Do you plan to sell or to rent?
Well, it's an opportunity zone, so that'll be a rental property. So we'd be committed to own and operating that for 10 years.
Yeah, a lot of sponsors have been talking about the build to rent space these days.
Yes. It's an interesting space. It's really becoming its own asset class within multifamily. We're not, our site is it's a 3-story surface park, suburban style, garden style project. So.
Well, we look forward to watching that project come to fruition.
who knows? Maybe we'll be talking about that one shortly.
We might be.
Yeah. And we are excited to talk about your adaptive reuse project as well. Before we get into that, what are those opportunities that you're looking for right now while you're working through your current transactions?
Its inventory is so low right now for people to think that there's just going to be this kind of groundswell of new opportunities, distressed opportunities. If it is, it's certainly not there yet. And nobody's really even talking about it, whether it's they have their head in the sand and people don't want to admit it or talk about it publicly. There's, in the Phoenix market so far in the first quarter, I believe there were 10 trades, only 10 trades over 100 units. So just not a lot of transaction velocity. So we're spending a lot of our time on this hotel project. We're spending a lot of time on some of our other existing assets. We're just kind of waiting it out a little bit, but I think there'll be opportunities. I think there will be some select opportunities for short sale opportunities, and primarily kind of going through the front door of working with a sponsor and the lender in conjunction to facilitate a sale there. There'll be some select note buying opportunities, so we can go back to 2010 and 11 and go back to that strategy. And then there'll be some other opportunities where people had owned assets, say they bought in 2015, 2017, or even longer, that for whatever reason they're at a life cycle in their investment that they're ready to exit. So before we get into our adaptive reuse 506C offering, I just wanted to kind of cover kind of a high level overview of the Sterling platform and some of the tenets that we really rely on and is part of our operating platform. I think what's really important to know is that we're fully integrated with property management, accounting, construction management. And that allows us to streamline communication, streamline decision-making, provide clear communication. The Sterling platform is a fully integrated operating platform. We have in-house property management run by my partner, Leanne. We handle all our own accounting. We run Yardi software, which is institutional software platform. We have our own construction management, project management. And so that really allows us to control the whole process and ultimately provide the best level of service to the project, but also allows us to make really timely decisions. Early in the formation of the company, we were using third-party property managers, and you just can't identify and address the problems quickly enough. So really being fully integrated allows us to control the whole process and really provides for the best execution of the investment. One of the other tenets of the company is just having a strong reputation in relationships with our vendors and our investors and our lenders. We treat our lenders as if they're partners. I learned early on in my career that your tenants are your customers. So without your tenants, you don't have anything. So it's important to provide a high level of service and make sure that all of our tenants are addressed. Our tenants' needs are addressed. Like I said, we treat our lenders like they're partners. There's nobody more important once you close a loan than the loan servicer or the asset manager and the accounting. So when we submit our draw requests, our policy is it reads like a little flip book. They have their chart, we have the invoice, we have the lien release, the cancel check. The loan servicer, they know when they get a draw request from Sterling, like top of the stack. It'll be the easiest one to go through, the easiest thing that they're going to knock out. And so for us, we're getting those things turned around in a timely fashion. And for us also to be very responsive to their needs. If they need something, we want an immediate same-day turnaround. So, because the flip side, we're going to be in the other situation where we need something from them, and you want to have that good working relationship. Reputation matters, relationships matter, especially in this environment. So integrity, knowing who you're doing business with, treating people the right way, all that stuff matters now. I'll give you a small example. We had a property in San Antonio during the Texas freeze where vendors literally couldn't drive down the street to get to projects. We had an apartment complex where all of our water lines froze and we had to shut down the water to the whole property. Like a lot of communities, there were hundreds of them in San Antonio. We got our plumber out there right away. We got our carpet water extraction company out there right away. And we were paying, and the carpet extractor water extraction company was a small vendor. we were prepaying them to do our units. So while other people weren't able to get a vendor out there, our vendor knew that they were going to get paid, and so they were really at our service. And our plumber, a lot of plumbers couldn't get parts. We were FedExing him parts from Arizona to Texas so he could have parts to work, and we were wiring him payments on a weekly basis. So that's what allows us to be, I think, small and nimble and do what we do and do it well. We don't do it on a big scale, but what we do it really, really well. And we have really strong relationships where there was a property across the street from us. They had water shut off for a month. So it's just, those are real kind of crazy stories that you don't hear a lot and don't happen very often. But when they do happen, you want to be in a position where you're going to be able to protect your asset, and having those relationships at the end of the day is what makes it. So we pride ourselves on really treating everybody that we do business with really well and have a good working relationship with them. And the last thing that is really important on any platform in the sponsor investor relationship is alignment of interest. So without that, it just doesn't, as an investor, you're really not in the best position. And so we always co-invest in our assets. We are not heavily fee driven. Our fee structure is really just to allow us to continue to operate the company, but we don't charge fees whenever you turn around to do something. So I think when investors get in and look under the hood and look at our structure, they'll find it to be a very kind of fair structure. And then on the promoted interest, we spread it around our entire company. So everybody in the company is vested. Everybody has, kind of quote, some skin in the game or will benefit from the total value creation. We allow our property managers to invest in the assets that they're working on. So we feel that that's, even if it's just a nominal amount, it's meaningful to them. But for people that actually have skin in the game, an actual cash investment in the asset, it's pretty rare at the property management level, but you definitely attract good people that way. And they're just people look after their own money just better than if they don't. And so it's also allowed us to have property managers follow us from assets to assets. Early on, when we used third-party management, we had property managers that would quit one company to come work for us at a different company, or on a different asset with a different company. They're willing to leave their company to come work for us. We had some maintenance staff move from California to Nevada to continue to work for us. So we have one of our best managers. He's worked on 6 or 7 turnaround value add transactions for us. And so he knew how well he was going to be treated. He knew that he would be empowered, and he knew he would be part of the process. And at the end of the day, he always received a nice kind of a sale bonus for the execution of the business plan. So for us too, we know we're having consistency. We know our manager is going to be there through the end, because that sale process, that last 30 days of the sale process, you can't have your financials kind of take a little turn. So it serves a lot of purposes, but at the end of the day, it serves our employees well. It ultimately serves our investors well, and then you get the outcome that you want. So that's just how we operate kind of day in and day out. Our process is fairly kind of broad. We like to cast a wide net. We want to evaluate all different kinds of opportunities so we can find the best values, just given really where the markets are at. Capital structures are important, especially in this environment. So we're always trying to sensitize out different financing structures, debt coverage ratios, refinance structures, to make sure that we have a capital structure that will work in all different kinds of environments. As we talked about earlier, our investment strategies we built out 3 kind of platforms, if you will: the value add of the existing assets, the adaptive reuse, again, that we'll talk about, the hotel conversions, or potentially even now an office conversion. You hear a lot about those. So those could come into play a little bit, and then new construction and development for the right situations. So as I mentioned to you before, Leanne Schofield, we've worked together for 8 years, very, very strong operationally. She is my partner at the company, and she handles all things operations. She runs the management company, she runs the asset management company, and because of her background coming up through property management, when we tour an asset, I always say she knows where the issues are. She can identify with the site staff. So she'll be able to really figure out kind of where the issues are operationally. Wendy Parlodine, she's been in property management accounting for her entire career, 30 years. She's had her own company. She's worked third party, extremely deep on the accounting side. And Nick Rowe is with us. Nick has that new construction background that you were talking about earlier, different skill sets. So as needed, we'll pull in other professionals like Nick, who's built thousands of units in the Phoenix market. Well, we're super excited about the Presidio Palms project. This was something that was germinated during COVID, trying to find distressed hospitality assets. So we've been working on this one a long time. We started the zoning, we started the evaluation process in 2020, and immediately started the rezoning and the entitlement process. So ultimately, it'll be a mid-century modern 212 unit at a market rate apartment community that's also entitled for an additional 154 units of new construction. So this is a 506c3 offering. This is the presentation here is just an overview. It's not an offering. Here's some fine print, but ultimately, if there's any interest, then we'll have to direct them to the website and all the legal documents. Quick overview of the project. We are at the crossroads of Granada and St. Mary's in downtown Phoenix. We are 2 blocks from downtown and nestled into the historic El Presidio neighborhood district. We won an award for the 2002 Metropolitan Pima Alliance. It's called the Common Ground Award, which is an award for projects that bring different aspects of the community together for an adaptive reuse projects that provides mutual benefit to the entire community. So we worked extensively with the residential district. It's a neighborhood where the residents take great pride in the historic preservation of the Arizona style homes in the El Presidio neighborhood district. So we worked with them to make sure that all of their needs were addressed, and long term that it was going to be a compatible fit for the neighborhood. And we ended up closing on the property in December of 2021. So we already own the asset, which is important to know. We own the asset. We've taken it through the entitlement process. We've taken it through the permitting process. And so for people coming in at the construction phase, all that risk has been eliminated. The financing risk and interest rate risk is, again, we've closed the loan. We have an interest rate cap for the full term of the loan. So what you're reading about in the newspapers of all the interest rate risk, interest rate increases and hikes really aren't going to affect this project. One of the real benefits on the adaptive reuse project is affordability. So we will have smaller units, which means smaller, just whole dollar nominal rents. And our smallest studios right now are projected to rent for $950 a month. And so to qualify at 2.5 times income, you can be at $28,500 in annual income. So that's below the 2022 60% HUD, the 60% AMI calculations by HUD in Tucson was $32,000. So in terms of, we are not affordable by any sort of covenants or restrictions, but again, just because of the small units and the nature of the project, we are just offering rents in that spectrum. So the native rents will be really attractive to the community. As I said, there is some additional value at some point in the site where we had it entitled for an additional 154 units. Here's an overview of the property. There's 6 buildings here that are the existing 2-story buildings. That'll be a traditional mid-century modern renovation. This is a 4-story building that has views looking backwards to downtown and then looking kind of northwest. These buildings here are part of the original hotel that will stay that way for the time being. This is some ballroom space that'll be just storage space, and this is the hotel lobby that'll be converted into the business center, traditional apartment office. You'll see here this is where generally the excess land is. So the new construction phase will what we'll do is we'll tear down these existing legacy hotel buildings, build 2 or 3 larger, higher density properties and some buildings along the perimeter for the new construction. So here's a good aerial where you can see how close we are to downtown. Downtown has about 40,000 jobs. You have some mining companies there, Hexagon. You have professional firms of Ernst & Young. You have a big city presence. The federal office buildings and courthouses are downtown. So you have quite a bit of diversification in jobs. Being on I-10 is a huge linkage for Tucson. It's a direct access to the airport where you have a lot of aerospace engineering companies. Raytheon, Northrop Grumman, Bombardier all have their engineering, and some of them have some missile defense, some real top secret stuff going on there. So being on the I-10 will be a big benefit for that. We will absolutely benefit from those jobs down at the airport. Here's a quick little just kind of rendering of ultimately what the project is on the left, what it'll look like on the right. In terms of capitalization for our offering, we are in the market right now for $4.9 million of equity for the construction phase. Currently, we have $9.9 million of existing equity in the capital structure, and Sterling Management has about 25% of that. So we talked about alignment of interest and skin in the game. Definitely checks that box. We have a loan in place, about $21.4 million is our acquisition and construction loan. So that's fully funded and ready for us to be drawn on. The total capital stack is $36.2 million, which puts and that's everything. That's our original acquisition costs, all our soft costs, all the hard costs, all the interest costs. It takes us to a brand new project of $170,000 a unit. For investors coming in at this point, it's a two-year investment horizon with a 1.5 multiple and a 23% IRR. Some of the things that we like about the asset, we talked a little bit about market fundamentals, obviously being close to downtown and the job story there. The first quarter 2023 occupancy numbers are still strong, 93%. It has been a little bit of a dip, but still at 93%. If you were to say we're headed into a recession and market occupancy is 93% in a secondary market, that's still pretty strong. There is still rent growth, 3.3% year over year rent growth. So as much as you hear of rent declines in a lot of markets, Tucson is still seeing a small uptick. As I said, our studio started about $950. If you want to be downtown, your studio rents are going to be $1,300 to $1,500 a month. So our whole premise is low-cost provider of the highest quality product in the downtown market. We'll look at another slide for best-in-class amenities. Generally downtown, you're looking at high-rise, mid-rise buildings. So you're talking small common areas. You'll look at our massive pool that's 12 feet deep, which is probably a holdover from the 60s. But it allows us to have an amenity package that you won't be able to get in any sort of urban environment in Tucson. The additional development that is just entitled, so whether we build it or we sell it to somebody else, the kind of orange pinkish buildings are the existing buildings, and the yellow buildings are the new buildings that have been approved by the city. Just a general location map of where we are in just Tucson in general, right off the freeway. High level kind of capital plan. We are spending $77,000 per unit on average. So 1 bedrooms and 2 bedrooms, and that's everything you see in the unit. The property was gutted down to the studs, essentially. All infrastructure in the property will be new. New domestic water, new sewer, new plumbing throughout, all new electrical from the transformers to the feeders to the sub panels to all the wiring. Everything in the unit will be brand new. We'll have Class A amenities. We'll have EV charging. We'll have a renovated pool, a fitness center, outdoor lounge, business center, dog parks, all those kinds of things. We're really, really proud of the floor plans. You're getting full kitchens in both the 1 bedrooms, and we'll go to the studios. One of the things that we're creating on the ground floor and a covered walkway, we are actually moving the sidewalk outside of the building, and under that area, we're creating covered patios. So you'll have about 20% additional space of outdoor covered patio space, but every unit will have a full-size walk-in closet, full-size bath, nice open kitchen with washer dryer units. One of the other things that we spent a lot of time on the planning phase was making sure that all the units, even the studio units, will have full kitchens and washer dryer units. So you can see even on the studio unit, if you're 315 square feet, you'll pick up another 40 square feet or so of just outside covered space. Part of the amenity package, we'll have a very large fitness center. So the idea is you don't have to leave the property. You'll have a full package of gym amenities, outdoor pool amenities. If you have pets, a dog park, a large fitness area. It's a massive pool that'll be surrounded by a lot of green space, volleyball court, patio seating, barbecue areas. Some of the benefits of having a low density site in the downtown.
Yeah. You're really providing a better quality of life for these people at a lower cost.
We love that it's the product, the uniqueness of the product that we're delivering so close to the downtown.
Yeah.
Right. Because you can go to, right, you want a nice Class A pool, you go to the foothills and get it, but you're $1,800 for $2,200 for one bedroom. So the plans to renovate the existing hotel lobby into a really large clubhouse amenity area for the residents. Well, they'll have different open areas where they can have different options to have a coffee bar or have a business center where we'll have computers and they can have a quiet area if they need to get online or if they need to do anything there. We'll have a little game room over here with some shuffleboard, or maybe we'll get one of the old school video games in there, but something for residents to come in and just kind of loosen up. There'll be a TV lounge area and just some other seating areas for guests that they come in while they're waiting to talk to the staff to get information about the community, or if they have any management issues or questions. There's areas for the residents to kind of congregate and enjoy the space while we separate it from on the business side of things, dealing with the site staff.
That looks amazing. That's resort style living in an apartment complex. I don't see that very often, if ever. We have a couple of units or a couple locations downtown Salt Lake. They have some of these additional amenities, and it's amazing that you have a property where an individual, or maybe it could be a couple, get a studio unit for less than $1,000, covered patio, pool, clubhouse amenities with the bar and the video area and the shuffleboard and all of that. Not only that, there's the gym, and that's a large gym. It's beautiful. And to be able to live there for less than $1,000, you don't see that. And so it's amazing what you're doing. Not only the amenities there, but the location to downtown. I mean, it could be, how far is it from downtown?
It's 2 blocks.
2 blocks. So walk or bike ride or scooter ride or maybe even an Uber, and that's so close. So to be able to live in that proximity to downtown for some less than $1,000, for other bigger units a little more than that, that's amazing what you put together and all the rehab that you're going to be doing to this project.
Yeah, you really hit on it, and that was the vision. That's what we wanted to create, and it's exciting to kind of see it all come together and get to the finish line. And I think it'll really be a great project for the community and the residents, and we're really excited about it.
Yeah.
Well, and some key points here that I see, David, when we're looking at this is, first of all, you've de-risked this for anybody that's looking to put money in at this construction phase. Essentially, you've moved through the process, you have your long-term financing in place, and you're personally invested into this deal. Almost 25% of the equity is your own money. And so somebody coming into this, obviously you believe highly in this project. And I think that's because of some of these factors. I would love if you go back to the location where you've got that aerial view, because some things to point out here is you're 2 blocks from downtown. So obviously, walking to their favorite bar or restaurant or whatever it is, they have that ability, and they really have that resort lifestyle if they never want to leave the property. If they're commuting, they have an amazing commute with the I-10 right there. But then also, if you look in the background here, you pointed out to us, that's University of Arizona. And so really you have a very large base of potential tenants coming from many different areas that are close to this location, and you have it not only priced right, but you have it priced better than units that have less amenities.
Right. That was, again, when we saw the site originally, we saw the potential just to be able to pull all those things together and to deliver something at the price points that we are. It obviously got us really excited.
Yeah. And that mid-century modern, to be able to keep it in that Arizona style and to win those awards, I can see why you're winning awards, because you're going to tie in with the people who are, truly grasp that Arizona culture.
That's right. And Tucson is really provincial. They take pride in South Arizona and Tucson. And so to really highlight that mid-century modern look, it's going to be nice. The interiors are going to be super sharp, very clean, modern. I think it's going to be a project that's going to resonate with a lot of people.
I mean, even the studios have a washer and dryer. Tenants don't need to go to the laundromat.
We fought hard for that. We fought hard for that. And really, one of the benefits of the adaptive reuse when we're bringing in all new hot water delivery systems and really programming everything from scratch gave us the ability to do that. And we felt that was a game changer for this project, for people to be able to have all the Class A amenities in this larger, as you said, kind of resort style living in downtown.
Well, not only the property that you're building and how amazing that's going to be, but even from a marketing perspective, since that's my background, to be able to market this. I mean, a resort style apartment complex this close to downtown. I mean, typically something like this would be more in the suburbs or on the outskirts, not in downtown essentially. So
Right.
even from a marketing perspective, I can see this, you being able to put a fun twist on this to promote it and get tenants in.
That's the direction we're going.
Yeah. David, this is an exciting project, and I don't think you're going to have a problem raising the funds. I almost slightly hope that it takes you a little longer and we get to participate with the PREIshare fund on some top-off services along the way, because this would be a fun one to do an on-site.
Well, we'd love to have you involved. It's, like I said, it's a unique project in that I'm not sure we'll ever do one like this exactly again. But it's definitely, as you go through your career, there are certain projects that kind of stick with you a little bit longer than others, and this certainly is one of them.
How did you come across this project? Because it's not a typical project that most sponsors would take on, and yet you've embarked on the journey.
Well, it goes back to just casting a wide net and really being entrepreneurial and trying to find value during the market cycles. And so as we talked about COVID and hospitality at that time, there was a window there where it was really, really distressed. The current ownership was undercapitalized. It was a family, mom and pop, literally, management team. And they were only operating in the 4-story building. The other 6 buildings were not in service. So they weren't capitalized to really even renovate the property as a hotel. And so I will admit, the first time it was presented to me, I didn't give it enough attention. And a good friend of mine said, "No, we're going to Tucson. You got to see this property." And so I knew exactly when we got there, you could see the potential and the potential vision for it. So
now, if somebody does want to get official offering documents and they would like to make an investment with you, what's the first step of that process?
They can go to our website. They can reach out to me directly. They can reach out to our investor relations email, but we will then invite them to our investor management portal, where they can sign all the necessary disclosures and documents and get all the information. And then they can set up a call with me, and I'm happy to answer any questions or talk to anybody individually with any questions or concerns they may have.
Thanks for watching another episode of the Fundication Show. To find more of our interviews that we've done, you can find us on YouTube. Go to youtube.com/@PREIshare to see more of our full-length videos of the Fundication Show. And if you'd like to join our investor and sponsor community, go to PREIshareCommunity.com to join in on all the conversations that we're having there. And thanks again for joining us.
Bye, everybody.